Hey everyone, welcome back to Corporate Decoder, the place where we take a deep dive into the nitty-gritty of corporate filings. And I've got one here that's a bit of a roller coaster, so buckle up as we decode J-Long Group Limited's latest annual report. This company operates in the garment trim industry, giving us a look at how fashion and finance intertwine. They've had a busy year with an IPO and a reverse stock split, and we're going to break down what all that means for their business. So let's get to it. Before we jump in, if you like getting clear, unbiased insights from these filings, make sure you hit that subscribe button. Also, we have a fantastic community over on our Discord, linked in the description below, where we chat about all things business and investing. We're starting with the key information, and honestly, the first thing that jumps out is how much of their business is tied up in Hong Kong. They've made it clear that the majority of their operations are there, and this brings a whole set of unique risks because of the relationship between Hong Kong and mainland China. They mention how PRC laws and regulations could influence their business at any time, which is a pretty significant statement. Changes in Chinese government policies can happen quickly and without much warning, and the company can't be absolutely sure about the risks from the Chinese legal system. It's like playing with house rules that can change on a dime. Now, it's important to note they aren't a direct China-based company. Their holding company is in the Cayman Islands with operations in Hong Kong and Vietnam. But this does mean investors are essentially buying into a holding company, not directly into the day-to-day operations. They've explained that their structure isn't to get around China's foreign investment rules, as their industry isn't restricted. Still, the possibility of future changes in Chinese laws affecting foreign investors' ownership in their Hong Kong or Vietnam operations is a definite risk factor they've highlighted. The report also flags that Hong Kong and China's legal systems are still developing and have uncertainties that could affect the legal protection available to investors. This is a broad but critical point. When legal frameworks aren't fully settled, it always introduces a layer of unpredictability. They also point out that overseas regulators might find it hard to investigate or gather evidence in China, including Hong Kong. This lack of direct oversight can be a concern when you need to understand what's really going on. Then there are the data security and cybersecurity regulations from China. These are becoming increasingly important for companies operating in or with ties to China. Failing to comply could seriously hurt their business and even make their shares worthless. They're also aware of the impact the Hong Kong national security law could have on JLHK, their Hong Kong subsidiary. It's a lot of geopolitical and regulatory complexity to navigate. A key concern for many investors in companies with Chinese ties is the ongoing debate about auditing. The report addresses this directly, explaining that their current auditor, ZHCPA LLC, is inspectable by the PCAOB, a US public accounting oversight board. However, they rightly caution that future auditors might face different situations, and if their auditors work in China or Hong Kong cannot be fully inspected by the PCAOB, trading of their shares in US markets could be banned, or they could even be delisted. This is a major risk hanging over many overseas listed Chinese companies. They also face the challenge keeping their shares above the $1 minimum bid price required by Nasdaq. While they did regain compliance by January of 2025, this kind of rocky compliance adds uncertainty for investors about the stability of their listing. Let's look at how the company itself is structured. They were incorporated in the Cayman Islands in 2022. They've gone through several reorganizations to set up their current structure, with holding companies and operating subsidiaries in Hong Kong and Vietnam. Their IPO was in January 2024, raising $7 million. This IPO was a significant event, marking their transition to a public company. Now, what do they actually sell? They deal in garment trims, things like heat transfers, fabrics, labels, and more. These are the smaller pieces that go into clothes, often adding a brand's logo or special features. A big part of their business, about 73% of revenue in 2025, comes from heat transfers. They also have a solid relationship with a US licensor, a major company for reflective materials, and this has been going on for about 25 years. This long-term supplier relationship is a definite strength. To reach customers worldwide, they have a sales and marketing team in Hong Kong and also consultants in Denmark, Italy, and Canada. For 2025, their total revenue jumped to $39 million in 2024. That's a solid 38% increase. This surge in revenue came with a significant increase in selling and marketing expenses, which jumped 60% to $3 million. This rise was mainly due to higher commissions paid to their overseas consultants as sales to non-Asian countries increased. So growth is happening, but it's coming at a higher cost. Their general and administrative expenses also went up by 27% to $5.5 million. A big chunk of this increase was in officers and directors' pay, which makes up about 64% of these costs. Let's look at the bottom line. For the year ending March 2025, net income was $2.06 million, a big jump from just $783,000 in March 2024. Importantly, their net profit margin improved to 6.4% from 2.8%. This is a positive sign, showing they're becoming more efficient. They've also managed their inventory well with the decrease in inventory value. Impairment expenses for inventory were lower in 2025 compared to 2024. It looks like they're getting better at predicting what they'll need. On the debt side, they have long-term borrowings, mostly from Hang Seng Bank, totaling about $1.4 million in loans. These are secured by property and personal guarantees from their chairman. While the debt isn't huge, it shows they are using leverage. Now, a very interesting part of any filing is related party transactions, and here Jaelong Group has quite a few. Their chairman Danny Wong and CEO Edwin Wong are father and son. Many transactions happen with companies owned or controlled by them. For example, they purchased a significant amount of garment trims from Guangdong Romian, a company partly owned by Edwin Wong. They also lease properties from Charm Vision Holdings Limited and Everlink Enterprises Limited, both owned by An. Danny Wong, the controlled companies, it's always something to watch closely. Their operating lease liabilities have significantly increased from virtually zero in 2024 to over $1 million in 2025. This is mainly due to new lease agreements for office and warehouse spaces, some of which are with related parties. This expansion suggests growth in their operations, but also an increase in fixed costs and liabilities. They also granted shares to consultants and an employee in late 2024. This is a common way to attract and retain talent, but it's important to watch how these stock awards affect future earnings per share. Looking at their business segments, they primarily operate in two main areas, Hong Kong trading and Vietnam manufacturing. For 2025, Hong Kong trading brought in about $39 million in revenue, $6,000. The Vietnam operation is still quite small but is growing. Their segment net income shows Hong Kong trading is the clear profit engine, while Vietnam manufacturing incurred a net loss in 2025. This indicates that while they are geographically diversifying, their core profitability still relies heavily on their Hong Kong operations. Now let's zoom out and look at the bigger picture. Jaelong Group has shown impressive revenue growth from 2024 to 2025, a 38% increase, and their net income has more than tripled. This is clearly a positive trend. They've also managed to improve their profit margins, which is always a good sign. The company is clearly working to expand its reach with new operations in Vietnam and a growing sales network. However, the risks are still significant. Their heavy reliance on Hong Kong operations means they are exposed to the geopolitical and regulatory uncertainties we discussed earlier. The developing legal systems in Hong Kong and China, combined with the global focus on data security and international trade tensions, create a complex operating environment. From a Warren Buffett perspective, we look for solid businesses with good management, understandable operations, and a competitive advantage. Jaelong has a long history in its niche, a significant relationship with a major US licensor, and has shown it can grow revenue and profits. The management team, particularly Danny Wong and Edwin Wong, are deeply involved. However, the concentration of ownership and related party transactions, while not necessarily bad, warrant close observation. The biggest concerns are definitely the geopolitical and regulatory risks associated with China and Hong Kong, and the potential impact on their US listing due to auditing requirements. In conclusion, Jaelong Group is a company on an upward trajectory in terms of revenue and profit, demonstrating a strong core business in garment trims and expanding its footprint. But the path ahead is not without its challenges. Investors need to weigh the growth potential against the considerable geopolitical and regulatory risks they face. It's a company with potential, but one that requires careful monitoring of the external environment it operates in. Alright, that's our take on Jaelong Group's latest report. What do you think about their growth and the risks they're facing? Let us know in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more decoded corporate insights. And don't forget to join our community on Discord, linked in the description. Thanks for watching, and we'll see you in the next video.